Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Zacks Senior Equity Strategist, Tracy Reinick. We're talking about housing markets today. And Tracy is actually our resident expert on housing, and she's the perfect guest for this topic. So this is going to be fun. Tracy, welcome back. Great to have you on the show.
Thanks for having me. And it is a perfect time to talk about housing, I feel.
Right. It is. So, according to a Bloomberg article yesterday, home buyers now need to earn more than a six-figure income to afford the monthly mortgage payment on a medium price home. And that is up about 46% from about $74,000 a year ago. And of course, this is mainly because of the surge in mortgage rates, and 30-year fixed rate on mortgages had surged to over 7%. Last week. Now it has come down a little bit, and this is up from about 3.45% at the start of the year. So that is a massive jump in mortgage rates. And this morning, according to the report from National Association of Homebuilders, homebuilder sentiment has dropped to a decade low. So let's talk about some numbers about existing and new home sales, cancellation rates, and all because of this plunge in housing affordability.
Yeah, it's definitely an interesting market for sure. And I'm not really surprised at the home builder sentiment because they've seen everything dry up at their sales center, or even people going online and kind of looking around on the website, because that's another way that they gauge interest nowadays. But interesting, the buyers are so rate sensitive that when you see a drop in the mortgage rates, like you just mentioned, where it was at over 7, and then it came back down to like 6.75, or even like a little bit lower than that, 6.6. Then they did see apparently a lot of traffic at their sales centers over just that weekend because they dropped 50 points. Now, there is a difference between the new home sales and the existing ones. They are in competition with each other, but new home sales, you sign a contract, you put down some earnest money, and then you have to wait for the house to be built, usually. Occasionally, they'll have some inventory on hand where you could buy it and close within 30 or 60 days. But during the pandemic, the lead times got really long to get a house delivered because of the supply chain issues and the shortages with garage doors and all this other stuff that was going on. So it was taking, in some cases, up to a year to get the house. But now, as a buyer, you don't want to wait a year because the mortgage rates are going up and you don't know how much higher could they go. You might not be able to afford the house by the time it's built. So these new, anything that is already under construction or is built already, anything in home builder inventories, they are still managing to sell that right now. And those people who came in on the weekend when the rates went down, those are some of the buyers for some of those homes. Also, I've been listening in on some of the home builder conference calls for this quarter, so that's a real good way to gauge on what's going on out there for the national home builders, because they're in so many different states and different markets. And a lot of them are seeing the rise in cancellation rates that you just mentioned. It's not as high as what it was in 2008, 2009, 2010, in those years where it was like 50% or more. Seen some in the 30s now, and that's year over year raise. And that goes into what cancellation rate is percentage of like the backlog. It's like kind of a weird computation that they figure out. But I was listening in on Beazer Homes earlier this month, and they said that on the cancellations, which did jump up, they are able to resell those pretty quickly, because if you're canceling, you've maybe been in contract for a while, it could already be close or, nearing completion or something. And then they're able to sell that to the person who comes into that sales center but wants it immediately. So they're not, the demand is still there. That's what's different between this housing market and what was happening in 2008. We still have a very good job market, and people got raises in the last 2 years. They want to own a house. They want new homes or the existing home. They just want something. And as long as they have jobs, even with those higher mortgage rates, they're still eager to get the house. But many of them right now with those mortgage rates are having to move to the sidelines because of the affordability side of things. But as soon as they come down, that's when, obviously they're jumping in, because they just go to 6, 7, 5. And suddenly, you see some people going to the sales centers again. But I still think we're going to have to see it come even, down much further, because those prices were at all-time highs going into this year. And with these mortgage rates, it's still unaffordable in large sections of the country, especially, the West Coast. A lot of the home builders mentioning that the West Coast is basically dead. That's frozen. Even if they do a rate lock or something, it's still very difficult with, basically the doubling of the mortgage rate to see the closings on that, or to see, the buyers really coming in on the West Coast. And then, more affordability they're talking about in the Midwest, which didn't see as much of like a boom bubble situation. And then also some areas of the Southeast, but not Florida. Florida is still, there's still strong demand there, but affordability is not really hitting so far in Florida, and it's still affordable in certain cities there, depending on where you're looking.
Right. As you mentioned, even though mortgage rates have surged so much, we haven't really seen a crash in pricing. House prices still remain high. And one of the reasons is that inventory is still low, because homeowners that bought or refinanced earlier around 3% or below rates, people like you and me, we are wearing the so-called golden handcuffs, because we'll be reluctant to sell our houses. We cannot buy new ones at 7% mortgage rates. So it appears there may not be significant unlocking of supply in the coming months. But I saw a research from Federal Reserve Bank of Dallas. It said that U.S. house prices could tumble as much as 20% in the wake of the surge in mortgage rates. Yeah. So we see a lot of comparison with the current cycle with that in 2002 through 2011, and whether there's going to be a housing crash like 2000. So you did some study on these two cycles. You compared the current cycle with the earlier cycle. Tell us about that, why it is not like 2008.
Yeah, there's a couple reasons. And one is they tightened the loan requirements for this cycle. So remember back in the day, during the last boom, there were some dead people who got loans, in fact, back in the day, and they tightened all of that. So you actually had to show proof of income and, go through quite an extensive process if you were home buying in the last couple of years. And so this group of buyers was actually the most qualified that we've seen in over 20 years, unlike the last cycle, where basically anybody who is dead or alive could get a loan, basically. So that is keeping foreclosures way down. And also, again, the good job market is helping with all of that. So the foreclosures are at, 20-year lows, and they've come off the lowest of the lows when they were frozen during the pandemic, when, you could not be foreclosed on. But everybody expected this rush of foreclosures once they got rid of the freezing on those. And it didn't happen. So people have a lot of equity. It's like basically record amount of equity now. A lot of people who bought in the last 10 or 20 years are, have a lot of money in their house. And so you're just not getting the kind of stresses that you had. Also on the inventory side, we are up off the lows nationally on inventory, but it's still well below pre-pandemic levels for this time of year. We are in the historically low time of the year because people don't like to list during the holidays, but it's way below even, a normal year. And then even if you just look at new homes, the inventory is like, 70% under what it was during the boom years because the builders were just building millions of units then. And then demand dropped, the investors left the scene, and then they were just left with all these houses that they couldn't unload. And that is not the case now. The builders they're very aware of what they went through just 14 or 15 years ago. And they have been more conservative this time, even with the boom that was the last 2 years. So they don't have as much land on hand. And some have been jettisoning excess land if they did have some kind of quickly. They're taking a loss on it, writing it off, but getting rid of it off their books because they're not sure for sure what's going to happen in 2023. But the underlying demographics still apply to this housing market much more than what happened in the last cycle. We now have the millennials, the largest generation in U.S. history, who are now marrying, forming families, and they want to buy. And we saw that in the last 2 years during the pandemic. It was a lot of millennial buying, up to 40 or 50% for the new home. Many of the ones that specialize in the first-time buyers type homes. Then, but even in existing homes, it's the millennial buyers that are driving it. Now, they maybe have gone to the sidelines briefly right now because of the affordability issues when those mortgage rates rose, but they're still going to be in the market. And the home builders all across the board keep saying the same thing. Like, we know they'll be back. It might not be in the next 6 months, but in another year, those rates come down a bit more, then, they'll be in a better position and they still will want to buy. So the demand will come back. So I don't buy into the whole, we're going to see this huge crash. Housing is very local. And, so certain things will happen in certain cities, even neighborhoods, that don't happen in others. So it's really going to be your local area and city and what was going on there the last 2 years. So Austin saw a huge boom. There was a New York Times article talking about people moving there from New York City, buying on the internet, sight unseen, getting in like crazy bidding wars with like 50 people, paying way over the asking price. Like, all that stuff was going on. And so that market is going to behave differently now that the mortgage rates have risen. It's frozen there from what all the home builders are saying, and they are discounting pretty heavily on the new construction homes. But inventory remains fairly low. So will they see the 20%? We don't know. But their prices are coming down quicker than some other cities like Chicago or Milwaukee that didn't see that kind of craziness over the last 2 years.
Yeah, you're right. Housing is very local. And as you mentioned, in Chicago, we did not see any dramatic surge in house prices in the aftermath of the pandemic. So hopefully we will not see a plunge either.
Right.
So during the pandemic, after the pandemic, when we saw this surge in housing prices in certain areas, the pandemic had supercharged the housing market in those areas. You mentioned some of those areas. So we saw a lot of home flipping and iBuying too. And that market has closed totally. Zillow discontinued iBuying, I think, last year, and recently Redfin also announced that they are closing their home iBuying division. So tell us exactly what iBuying is and what is happening in that area.
Yeah, so iBuying is using a computer algorithm to determine the price of the house. And you hear these ads on the radio or TV in your neighborhood. I hear them occasionally here in Chicago still, but it's when you can go directly to them and say, I want to sell my house. They run the computer algorithm on your house in your neighborhood and offer you a price. So you can sell directly to them without any real estate agent. So you cut out the costs of the real estate agent. You don't have to fix it up. You don't have to try to convince some buyer to like it. You just sell it to the iBuyer and walk away with the cash, basically. So this became very popular during the boom of the last 2 years. And, all three of the ones you just mentioned, Opendoor, Redfin, Zillow, were the big iBuyers. And in certain cities, it was more than others. So Phoenix, Charlotte, some of those cities, Las Vegas, had a lot of iBuying activity. They would come in after they purchase it and they would do the repairs on it, which they tried to find homes that needed just like minor repairs, cosmetic, sometimes just paint, maybe some new carpeting or flooring, some things like that. And then they would relist it for more money. But you can do this when the market is super hot and everything is going up, up, up. But as soon as it started to slow is when some of these iBuyers kind of got caught. And their algorithms, as good as they believe them to be, were not really designed ever to see mortgage rates double in like 5 months. That was not even a scenario that even the, computer would ever try to figure out. And so they got caught as the market slowed, and now they cannot flip the houses for more money, which is why Redfin and Zillow have decided to get out of it completely. Opendoor, it's their whole entire business model. So for the most part, although they are starting a few other things on the side now, but they're taking the losses. They had almost $1 billion of losses this last quarter. That is mostly from houses that they bought in the second quarter. Kind of that was the peak pricing before the mortgage rates started to surge. And they're just trying to dump it and get rid of it all. And they are buying fewer homes now, but Opendoor is still doing the iBuying. They are still believing in the algorithm, and that now that the rates are up there, the algorithm can figure it out and they can still make money off of some of their homes. They also have tried to figure out, they were a little bit longer time to do the repairs because like everywhere, there were no repairmen available. Construction workers were slim. They had to wait on a lot of things. If they're putting in new appliances, they had to wait because of supply chain issues and all of that. So they're hoping to get the number of days down that it takes them to flip the house. I think it was like around 30 days or a little bit longer. And they're trying to get it under there because that cuts down on the time they have to hold the house, right? They just want to get it and get it back out there on the market as fast as possible and get it resold. And they claim that the third quarter houses that they've been buying are profitable. They are able to sell those so far, with the better margins and everything. So they're still in the game and there still will, be impacts. But for now, they are dumping a lot of their inventory. Redfin is just doing the same thing to get out of the business completely. Zillow may even still have some houses available, even though they got out of it about a year ago now. But that's going to put pressure on prices in those particular neighborhoods or cities if they're kind of concentrated. Like in Sacramento, there are quite a few homes owned by the iBuyers that they're just discounting. So in those neighborhoods, you might get a deal or it might impact the appraisals on, nearby houses. But other cities like Chicago, we didn't have any of these, or those particular three iBuyers were not in the city of Chicago, but they were a little bit and a few iBuyers in the suburbs, but we never saw the huge influx like a Phoenix or Las Vegas or Sacramento, some of those cities saw. So that is a little different. These iBuyers were not around in 2008. In their place in 2008 was just like the mom and pop investor and the flippers back then. And some of them got caught in the downturn, but they're not big, publicly traded companies like Opendoor. Opendoor went to the public market. They got 2 financings recently. for $700 million to help cover some of these losses. But, back in 2008, the mom and pops could not. So they would just turn in the keys in 2008. But now it's just being discounted instead for a loss.
Let's talk about the rental markets now, because so many prospective home buyers are now being priced out of the housing market because of affordability issues. So the rental market was very hot over the past year or so. And in fact, rising shelter costs were among the biggest contributors to core CPI. But rental prices have started moderating a bit, and that is also because of some of these job losses that we have seen, particularly in the tech sector. And in fact, when the CPI numbers for the month of September were released, many experts then said because rents are factored into CPI on a lagging basis, so inflation is actually coming down. So what are the trends that you have seen in rental markets, particularly the hottest ones?
I think what you just said is correct, that we're not seeing the pressures anymore on the rents, except in a few key markets. So there is still some craziness going on in New York City. Like, I can't even believe the rents that I see there. And I watch all those YouTube videos. If you want to get a handle on what's going on, you can go on YouTube and just do like apartment hunting in New York. And there'll be a ton of videos with people just going from apartment to apartment. And you can kind of see they always put the price and what you get for it. And those prices are not coming down because the cities are popular again. So again, it's going to be local. It's going to depend on who's moving and the job market in that particular city and how many apartments they've managed to build. So in Chicago, we are at record levels of rents on apartments in the downtown for like the luxury side, and even one more down from the luxury, the Class B, as they call it. Both of those were at record highs, but it seems to have kind of peaked out. And now you have to watch occupancy levels for all of these cities, because that's always the key. The same with home buying is there inventory? Then you might have some negotiation with the landlord, or they start putting out incentives, 1 month off or free parking, which they all had to do during the actual pandemic, the first year in 2020. So people got really good deals in 2020 for that reason, because everybody fled the cities. But now I do think we've reached the peak for this cycle in the rents. And we are beginning to see some layoffs, as you mentioned, and that is going to impact depending on what market you're in. I know in Silicon Valley, I moved out there just after the dot-com bust, and the apartment buildings were finally emptied because everybody had left afterwards. And I managed to snag a pretty good deal that was well below what it was renting for, like in the year 2000. And I got in there in like 2002, I think it was, or 2003. So yeah, that part is starting to slow, and that's good. That's healthy for the housing market.
So let's talk about Homebuilder stocks and related stocks as well. So the two popular home building ETFs, and we'll talk a little bit more about the two ETFs a little bit later. They are both ITB and XHB. They are both down 26% year to date. So they have performed much worse than the S&P 500 index, but they have rebounded very strongly in November. Both are up about 11% this month, and that is thanks mainly to these cooler than expected inflation readings. So home builder stocks have started rising, and so many investors are they're wondering now whether these stocks have been too cheap to ignore, whether this is the right time to buy, or it is better to wait for some more time. Are we going to see another leg down? And in addition to home building stocks, we have seen a lot of interest in home improvement related retailers and other stocks too. Home Depot reported yesterday, Lowe's reported today, and they both reported good results. And in fact, they said that demand for renovation projects remains very strong. And particularly because people still have a lot of cash, and people who are stuck, who are not able to sell their homes because mortgage rates have gone so much. So they are wearing those golden handcuffs.
Yeah.
So they want, many of them are still working from home. So they want to renovate their houses. They want to improve their houses. So there's a lot of demand for home improvement goods.
Yeah.
So what do you think of home builder stocks? Do you think it is time to look at home building or home improvement or construction material stocks? And then if you think it is the right time to buy them, then what are your favorite stocks to look at?
Yeah. Okay. So I'm kind of mixed on this whole area. I did own the home builders in the value investor portfolio, but we did sell because the rates were rising. So you got to get out. And they all came down. They are all, even as a group, dirt cheap, like under 10 on the PEs. But the thing with the home builders is that the numbers they're reporting right now on like revenue, gross margins, those are all near record highs because they're basically delivering their backlogs now. The huge number of orders they've had, and that took them a year to build, they are finally turning over the keys to the buyers, and then they book that revenue, and they're booking that price that they was paid months and months ago. But the outlook going forward is what doesn't look quite so good. So for instance, Toll Brothers, the luxury retailer, their earnings expected to be up 40% this year, but down 17% next year. So I'm a little reluctant to think the worst is over with the home builders. And they've all said the same thing on the various conference calls. Toll Brothers is Zach's number 5 right now already. They haven't even reported their next earnings yet until December because those estimates are still being cut for next year because they basically have to be. The sales will slow, even if mortgage rates come down as they just have off that 7%. It's the Fed is taking some of the speculation and the mania and the urgency out of housing. And that just means less people are going to be going to the sales centers. And then the job market is the wild card. We haven't even had that hit really. We have had some layoffs in the tech areas, but nationwide it has, still the weekly jobless claims are still pretty low. And we're at 3.7% unemployment rate. So until that rises further, the home builders are still seeing some demand, but I do think it's going to get more tough for them next year. They're all preparing for it and ready for it and know they just kind of have to make it through. So for me, it's just a little too early. But that being said, the home builder stocks will start to rally well ahead of the overall, housing market in anticipation of better days. But I'm not sure we're in that type of rally right here. I feel like this is more of a fake out. So Toll Brothers is dirt cheap. It's trading it with a PE of 6, but I'm still on the sidelines, even though if I was going to buy one, I do like Toll. It's the luxury home builder. And 20% of their customers pay all cash, and they do customized homes. So their cancellation rate is a lot lower because they have a big down payment you have to put down for Toll. And if you're going to build a custom home, you really are you're going to close on it. It's your dream home. You've waited a long time to get it. You're putting 2 home offices in there and your dream kitchen, all of that. And you're unlikely to cancel if you can at all help it. So, and then there's the 20% cash. So they don't even care what's going on with mortgage rates for them, as long as they have jobs and whatnot. So I do like Toll, ticker TOL. On the more affordable side, Beazer, I mentioned earlier, they just reported BZH. I did like their outlook on the conference call because they were kind of going with the flow. So on their cancellations, they did say that some of their buyers are willing to walk away from the deposit. It's not as big of a deposit as Toll Brothers, but it's unusual to see any kind of customer walking away from thousands of dollars, but they're willing to do it because some other home builder nearby is giving them $50,000 to $80,000 off the price of a home. And these are more affordable. So they didn't say what the earnest money was, but let's just say it's $20,000 or $30,000. The other home builder is going to give you $80,000 off the price compared to what you were already buying with Beazer. So that's, if you're walking away, you're still saving $50,000. So it is interesting to me that some of these buyers are willing to do that, but Beazer could and has been selling that house if someone's walked away from it as well. So it's not hurting them that much here. And they're trading super cheap, 3.6 times, but they're also, along with Toll, a number 5 strong sell right now because those earnings estimates are coming down for next year because the sales are just going to slow, which they all know. Beazer is also not a customized build to order type of home builder. They, just you get what you get. And so you walk into the sales center and you might be able to customize a few things on the interior, but not as much as you can with Toll. And then it's just, they're just building the spec homes for the most part. So, but there's a, dozen other names that I also still do like, because I do like the home builders here. This is not a replay of 2008 where they got into trouble with excess inventory and land, even though a lot of like housing bears keep saying like, look at all the houses they are still constructing, but a lot of those will be sold and they're not at the levels anywhere close to what they were building in 2006 and 2007 into that recession. So on the home builders, I would keep them on your watch list. That's what I'm doing because I don't think that they're done with this cycle of, that they have maybe one more leg down before we get the rally.
What about home improvement and furnishing retailers? Do you like any of them?
I do, yeah. So Williams and Sonoma is one of my favorites. They're about to report earnings this week. They might probably reporting by the time you listen to this podcast. So check out what they've done. They have been reporting record quarters, much like the home builders, because once you buy the house, you want to buy the furniture, right? They kind of go hand in hand. And as you mentioned, Nina, everybody's still, or a lot of people still working from home, and they were buying things for work from home still, even in the last year. I don't know about everybody else, but my chair is getting a little tired from the last couple of years. So you have to get a new one. Like these are things that are happening now and your house just gets more use, like all the furniture and items in it. So Williams and Sonoma still able to, kind of cash in on that aspect, but they also have another branch of business that they're growing pretty quickly. Their B2B business, and that's on the business side. So restaurants or hotels that are opening, they're selling directly to them. And they think they can get that, up to $1 billion a year business. And they just expanded on the kitchen, commercial grade kitchen with like dinnerware, breakfastware, some of their electronic kitchen gadgets and stuff are now commercial grade. So that's a big area. And if residential slows down, they at least have maybe the commercial that might not slow down as much. So I'm liking everything that they're doing. The shares are cheap at 8 times, but it's a matter of what will happen next year. The same with the home builders. Right now, we have the Zacks consensus declining 6.5% on the earnings next year. That's not too bad, but we don't know. We'll see what they say when they report now. Are they seeing further slowing? So far, the consumer's been holding up just about everywhere. As you mentioned, Nina, Home Depot, Lowe's both had pretty solid reports. And the other furniture retailers who've reported so far have been excellent so far. They are seeing a slowing, but it's not terrible. It's not falling off a cliff, and they're preparing the business for it. Williams and Sonoma also has a huge share buyback, and they're considered one of the dividend aristocrats. They paid a dividend for 15 years or more, and they've been raising it, but they have a yield right now of 2.3% on that dividend. So, and they raised it, I think it was 10% this year, and they raised it 20% last year on these record sales. So I like Williams and Sonoma, WSM, and we'll see what they report. I also like Pool Corp. That's one of my favorites. Anybody who follows me on Twitter is always like, why is she tweeting out again about this pool name? It's the ticker is Pool, Pool, and yeah, they do the pools, and it's worldwide. Europe, Australia, North America. Obviously, any warm area is their big market. So North America is big. They do both the new pools. They do remodeling. They do all like outdoor, like landscaping, like the whole 9 yards, and that's all we've wanted to do the past couple of years with the stay at home. And so they've been killing it, record quarters, but they are starting to see some of the slowdown in their last earnings. And then they did narrow the guidance for this year in the last earnings. So the shares are down a bit, but I'm still waiting for them to get a bit cheaper. They're trading at 18 times. I'd like to see them under 15 times. But I've been just kind of waiting. They haven't gone there yet, but that may still be to come too. As more, if the consumer slows further, they will see further slowing on the pool side. But right now, remodeling, as you mentioned, is big for them too, and customization, and that is taking the place of the new pools, which are kind of normalizing back to like pre-pandemic levels now. Everybody who wanted a pool during the pandemic has gotten one, apparently. But, new construction, that's always a driver too. If you bought that new house in the southeast part of the United States, down in Florida, or even in, Texas, those areas, you may want to put in a pool. So I like that area. It's just, who doesn't like pools? Everybody does. And another area that's kind of related is decking. So I've been watching Trex, which is TREX. That's the composite decking company. And they boomed too during the pandemic, because if we put in the pool, or even if we don't have a pool, we wanted that deck out in the backyard. So Trex was doing well, but they are seeing the slowdown now. They had a little too much inventory at their kind of retail or wholesale partners, the ones who are selling the Trex. Too much inventory there, so they've had to reduce their own production so that they didn't have a flood of inventory out there. And they did do some layoffs, so the stock has gotten hit. It is, down pretty big year to date, but I keep waiting for this one to get cheaper too. It's trading at 27 times still, and earnings expected to be down this year 15%, and then another 7% next year. But this is one, again, it all depends on the consumer, right? If they're still working, if the job market slows but doesn't get hit real hard, then companies like this will, kind of ride it out. But we don't know yet what's going to happen in 2023 with either the job market or the consumer. So I'm just keeping some of these on my watch list, because again, the millennials are still going to be buying. We're still going to want to put that new deck out back eventually, even if it means a year from now instead of in 6 months.
So all very interesting stocks. Let's summarize the stocks first. Toll Brothers, ticker symbol TOL. Beazer Homes, ticker symbol BZH. Williams Sonoma, ticker symbol is WSM. And make sure to look at the report. They are reporting tomorrow. And Pool, ticker symbol is POOL. And then Trex, ticker symbol is TREX. All very cheap, very attractively priced now, but they become cheaper, as Tracy mentioned. So just keep them on your watch list for the time being. And if you want to look at the ETFs, there are two popular ETFs in this area, and there are significant differences between the two, which investors should understand. The most popular Homebuilder ETF is by iShares. It is the iShares US Home Construction ETF. Ticker symbol is ITV. It is market cap weighted, so it is quite top heavy. The top four holdings, DR Horton, Lennar, NVR, and Pulte Group, they account for more than 45% of the portfolio. Wow. And you get a lot of exposure to home builders. Home builders currently account for about 66% weighting in the portfolio. The other ETF is equal weighted. It is the Spider S&P Home Builders ETF. ticker symbol is XHV. And in addition to home builders, this has significant exposure to building products and home furnishing companies. And so if you are more positive on related companies like Home Depot, Lowe's, Williams-Sonoma, then maybe take a look at XHP. Tracy, that was great discussion. Thank you so much for joining us today and for sharing your insights.
Thanks for having me. And hopefully I'll be back on in 2023 and we can discuss what is actually going on with these things.
Right. Yeah. Make sure to check out Tracy's podcasts. She hosts 2 weekly podcasts, Zach's Market Edge and Zach's Value Investor. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe to this podcast and all of Zach's podcasts so that you do not miss anything. If you have any comments, questions, or suggestions, please email podcast@sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.